Glenn, credit by a number of measures is on track for its worst year since 2008. Is the credit market headed for trouble?
So I would say it doesn't feel like we're close to 2008. I would say that fourth quarter 2015, first quarter 2016 felt a lot worse than it does today.
Well, the moves were way more violent.
They were much more violent, and I think there's a different type of concern today than there was then. And by the way, 2011 wasn't exactly a walk in the park either with the euro. But so what I would say is that today's market is about fear of recession, because everyone says it's the end of the credit market, it's the end of the cycle. People are concerned about the Fed raising rates, inverted yield curves. People are concerned about China trade war. People are concerned about the Middle East. People are concerned.
A little bit of Brexit in there,
A little bit of Brexit. We'll get to Brexit. I'm going around the world. So start with the U.S., and people are concerned about Brexit. People are concerned about Italy. People are concerned about German elections. People are concerned about China in general. So not leave alone emerging markets, because those are now back burner this week. So there's definitely anxiety in the market today. And yet I would say the fundamentals in the U.S. right now are still okay. And
so the anxiety is unwarranted?
So no, it's not unwarranted. I just think that the biggest question is, how close are we to recession? And it almost feels like everyone, it's a fact that's coming. It's just about when. And yes, economies are cyclical. But you can't ignore the fact that we had fiscal stimulus at a point of having full employment. And the Trump tax cuts are pretty substantial. That's what led to the earnings growth this year. You can't ignore that there are more job openings today than there are people looking for jobs. You can't ignore that consumer confidence is near 10-year plus highs. And so to me, it's not necessarily a fait accompli that we're going to have recession. I don't believe we're likely to have recession absent geopolitical, which I'll come back to, in 2019. And I actually think that Trump is so motivated to keep the economy going, to keep the markets going, that I think he will take actions, even with a Congress that might not be so supportive, to basically keep the economy going so he gets reelected in 2020. And he has at his disposal some things he can do. I mean, the trade war today is one of the greatest sources of concern that's out there. It's really been his doing in terms of how he set this up. And he has the ability to, with his policies, to get a trade deal with China, because I believe China would like to do a trade deal, and it's just a matter of what kind of terms are likely to get accepted by the Trump administration and in China. Trump does have the ability, especially as it relates to China trade policy, to cut a deal.
To snap his fingers and make it go away.
Well, snap his fingers is a little extreme, but he has that ability since he set it up.
Yes.
And so I think if there was a trade deal with China, which would definitely be better than what we currently have, I think the markets would be very, very excited. And I've had the view all along, if the trade war did not bubble up, I think the economy would be in a better place today. I think rates would be higher, by the way, because the economy would be in a better place. So I think that's one possibility for Trump. I think infrastructure spend is something that maybe he can get done with the Democrats. I mean, again, we're in an uncertain place. I didn't mention that earlier in terms of U.S. anxiety in the markets. And again, so I don't think, so to go back, I don't think the anxiety is going away anytime soon. Brexit's going to last for at least another month. The Fed, you're going to see if they bump rates. I mean, Trump's pressure on Powell is interesting. We'll see if it has any move. I happen to believe it's still going to be data dependent. And so I think you're likely to see a rate increase, and I think rates are likely to drift higher so long as the economy grows, because I think the Fed, rightly so, wants to have the ability to use rate cuts in the event when, not if, but when the economy weakens. But I don't necessarily see the certainty by any stretch of a recession in 2019. In 2020, we'll see. And then you go back to, what does it all mean? again, people want to talk about late cycle economies, but the equity markets have its set of challenges too. And I would put forward that in many respects the equity market challenges are just as great, in that the earnings power growth, which came a lot from the tax cut and the growing economy, a lot of that is behind. And I think there's probably more value in the equity markets today than there was, given how many stocks are down. And again, this concern of it being late cycle. But it's not a fait accompli to me that we're into a recession. And the last thing I just would say is that if you look at the growth in this economy over the last decade, while we may be in fact in the 10th year in the longest, the second longest or longest recovery of all time, the magnitude of the growth is only half of what it's been in past cycles because we had such an anemic recovery. And so I saw Janet Yellen after she left the Fed, and her comment was a good classic line, which was, economic cycles don't die of old age. And so it's not imperative that it dies. And Powell, just a couple months ago, seemed to suggest that this growth could go on for many, many years. So I think all the doomsayers, again, I understand why there's risks in the market. We can talk about pricing and value, and we'll get to that. But to me, you need to be smart. You need to be a good picker, and we'll get to that later.
If that's the case, why is it that respectable people like Paul Tudor Jones, are warning of scary moments in corporate credit?
So here's what I'll tell you.
What does he see that you're not seeing, or what are you seeing that he's not seeing?
Well, I think we actually see probably the same things and probably interpret them slightly differently. And so let's talk about the bear case for credit.
Okay.
Bear case for credit is leverage multiples are high, highest they've ever been. Okay? Let's talk about the offsetting factor when I go through each one. Equity multiples, EBITDA multiples on the equity market S&P 500 have gone from 8 times to 13 plus times, while credit's gone from 4 to 5 and change. Okay. There's so much debt, companies are so susceptible to rate increases. Interest coverage, mitigant, interest coverage is the best it's been 4 plus times for bank loans. So in part that's because rates are low, but because a lot of companies have interest rate hedges on, the magnitude is a half a turn of coverage. So I don't see that as a big issue. The covenants, everyone, Janet Yellen, covenants are horrible. This is going to be the cause of the next crisis in bank loans. First of all, I don't see how a $1.3 trillion market that's 60% owned by locked up vehicles called CLOs is going to, there's no forced sellers, again, an offset. And I don't see how that causes this gigantic cascade of credit issues. We'll come back to what could be some credit issues. So the fact that covenants are few and far between today is unquestionably an issue. Okay, 85+% of bank loans today are covenant light, or said differently, don't have covenants. They want you to pay back at the end. But the fact is, when you look at history, the return on covenant-light debt is actually the same as covenanted debt. Pretty much identical. And you look at me and say, how is that possible? It's possible.
Or either that, or why is everybody freaking out?
So we'll come back to why people are freaking out. But the reason why the returns are the same is because if you have no covenants, then you don't default. When you do default, you have a worse outcome. If you have covenants, you default, and you have a better outcome. So you have higher default. So the price times quantity equals the same, basically. And so, to me, the thing
You've just handcuffed your investor, that's all.
So you've handcuffed your investor. Well, you haven't necessarily handcuffed your investor because you can sell. If you don't, and the real key to me is really all about credit selection. So I don't think there's likely to be a big default upswing anytime soon, because there's no maturities anytime soon, because the entire market's been pushed out for 3-4 years in terms of any real maturities, and there's no covenants. And so you're not likely to default, and there's a lot of capital available for companies that need liquidity. And so I don't think there's going to be a lot of defaults. So what is Paul Tudor Jones, what are others worried about? I think there's legitimate concern that some companies have taken on too much leverage. And they were able to issue debt with very, very low coupons because rates were near zero. And if you take a 5% coupon bond and and events turn out that the market wants to reprice that risk at 10%, those 500 basis points on a 4 or 5 year duration is 20, 25 points. Boom. And for investment grade, it's an even bigger trouble. So I think the bubbling concern about investment grade, the concern that there are definitely companies that are too levered. If we have a recession, when we have a recession, then there's no doubt that credit spreads will widen, and there will be some companies that perform very, very poorly. And so, to me, I don't like to make a general call that credit is I don't sit here today and saying credit is cheap. Let's be clear, okay? I think credit is fair. I think there are companies that are issuing debt at values and with yields that are fair for the risk that are being taken. And I think if an investor does a good job of sifting through the entirety of the universe and deploying capital in a very judicious way, I think you can make reasonable returns.
Sifting, that's
Yes.
a key word, because at least from 10,000 feet, the credit market over the past 10 years looks a lot like the stock market in the sense that beta was a good investment. You didn't really have to pick that well to earn a return in the credit market. How sustainable is that?
So we've always been focused on alpha. I'm sure many managers say the same thing. I think to the extent it's hard to envision, notwithstanding my comment that economic cycles don't die of old age, it's hard to envision that we're not closer to a recession than we are to the beginning, to the peak, to the earliest stages of growth. And
similarly, closer to the end of the cycle.
Close to the end of the cycle. But again, that cycle doesn't need to go away in 2020. It can go 21, it can go 22. It can go later. There's no clock that says it's automatically the end of the cycle. Okay, and so the U.S., the real thing that I look to on this point, and again, I've been doing this now for over 30 years, is you try to look back at different periods of time and say, what can you learn from those periods of time? And the period that I look to think about for this market moment that we're in, one of those periods is the 90s. And in the mid-90s, after the economy was in a recession in the early 90s, and then the Fed cut, and there's great distressed market, and the world came back, in 1994-95, the Fed raised rates a lot of times. And the long end of the market went up, and people were all concerned it's the end of the cycle, we're going to get an inverted yield curve. And what happened after 95 and the next half of that decade is you actually had reasonable rates that went sideways, and the equity market tripled. And how did that happen? It happened because we got a ton of productivity. And so there's an open question right now. Will the tax cuts spur more capital investment to get higher productivity to help extend the cycle? And that's a possibility. Now,
Haven't seen it so far.
Haven't seen it yet. And again, I actually take the view, but that's one possibility.
Mm-hmm.
The second possibility that has worked in the past is China stimulated the economy to such a great degree. I like to say that the Fed saved us through the global financial crisis, but China actually took us out of recession because the amount of growth in China from 2009 to 2012, 13, 14 was extraordinary. I don't see that growth engine this time. And so, again, I have sympathy to the people who are more bearish with the amount of uncertainty, the lack of escape hatches, and just the realities of being 10 years in. And so the question, and I think it's a fair argument to say, are you getting paid enough to be in credit? And are the spreads wide enough? Are the absolute yields wide enough?
What's the answer?
And the answer is you're getting paid fairly. That's what I would say. I think if you can buy leveraged bank loans today at LIBOR 350 to 400 and make 6+% and essentially be lending at the 50% loan to value, I think that's reasonable, especially if you pick well. If you just buy the market, it probably won't turn out to be as good a selection. And with the 3%, 2.5-3% short rates, I can understand why people are pausing a bit. But I think leverage loans still make sense.
But it doesn't sound to me like you think the people who have piled in to investment grade and junk ETFs are going to get carried out of the building on a stretcher.
So here's what I'd say. You're lumping two things, junk ETFs and I know people still use the word junk. And triple Bs, so it's a whole separate story. Here's what I think. In my experience, 31 years doing this here, you need a couple of conditions to be quote unquote carried out on a stretcher. You need a recession. Okay, let's look back over 30 years. You had a recession 91, you had a recession 2002, you had the big global financial crisis 2008. If we have recession, make no mistake, rephrased, when we have recession, there will be some spread widening in credit.
Of course.
Okay. And by the way, equities won't do so great either probably during that time.
Maybe worse.
Okay. Probably worse. Okay. Obviously, just like anything else, depends on your selection of your equities. So you need a recession. The second thing you need is forced selling. Okay, so if you look back in 1991, you had the S&Ls, insurance companies, forced selling. 2001-2, you had the investment-grade mutual funds selling when Enron and WorldCom happened. 2008-2009, you had a massive margin call in the system, and anyone who had mark-to-market leverage got called out. So the question for me is what are the conditions that would force people into selling? So let's just step back for a second. If you look at the loan market, I'll cover a couple of markets. If you look at the loan market today, only about 6% of all loans are held by hedge funds. That compares to about 25% back in 2007. Loan mutual funds, say, took up all the balance. They were like 8%, now they're 25 or so too. And so, and CLOs, which are not marked to market, and CLO performance has been quite good and really vindicated through the crisis. While downgrades to triple C can force some selling or encourage some selling, it's not the magnitude unless, again, you go into a massive recession. And so I don't see so the two conditions that are required. Now, the third thing, by the way, is geopolitical. So geopolitical, go back, 1991, you had the Gulf War. 2001, 2003, obviously had 9/11 and the ensuing tech bubble burst. And 2008-9, you had the global financial crisis. And so the question is, which of those conditions end up forcing a bloodbath, so to speak, or a real, carried out on stretcher moment? And I don't see them just yet. Now, again, that doesn't mean that anyone just buys a bond fund or a loan fund is going to make double-digit returns, because I don't think the market is not really setting itself up for double-digit returns. But I would put forward the view that if you can make 6-7% in bank loans or high yield, or if you can make 8 to 10 or 11 or 12% in private credit, and be opportunistic and distressed and find some selective opportunities to make 10 to 15 plus, that compares very favorably on a risk-adjusted basis to private equity, given what's happened in that market and the explosion in that market. I think it compares favorably to a lot of equities too. So I think that credit, I don't debate for a minute that one needs to be defensive now. And I don't think there's enormous excess premium that's being offered. Although I will tell you, in the last 2 months, the spread widening in high yield has been pretty dramatic. Triple Cs have widened out 200, 150 plus basis points, as they should have. Mm-hmm. The energy, the price of oil and its decline is certainly having an impact today in the high yield market, where 15% of the market is energy. And so, right. Again, I think it affords the opportunity for discriminating investors to really choose where they want their exposure. And just beta, no, I don't think just beta, but I think there's substantial alpha opportunities.
Does it feel to you like spreads in high yield are going to plateau soon? We're at what, 425?
So, yeah, 425, 429, I guess it was on Friday's close. But look, we have looked at the last, we look obviously at lots of different periods. We've been in this range of 320 to 420 over the last year plus. I think they still could widen some, because I think the backdrop from an anxiety standpoint is still reasonably high, given all the things we talked about. I also think that if energy pricing, if oil pricing stays here or goes lower, then I think you'll have that impact on the market. And so I think overall spreads could widen a bit from here, but absent a recession, I'd be surprised. If you strip out energy, I would be really surprised to see them widen much beyond 500 on high yield. And bank loan spreads, the stated spread is LIBOR 4 and change, but the reality is that includes a lot of lower quality credit names. And if you actually pull those out, probably between 375 and 400.
Is it possible, given the scenario you're painting, a lot of anxiety in the market to a degree that reflected somewhat in spreads, at the same time, strong economy, the possibility that the president, in his effort to deliver on his promises, will make some changes, to keep the tailwind blowing, that maybe risk is underpriced and there could be a rally in 2019?
So I think you could absolutely see a scenario where spreads tighten 50 to 100 basis points. If you get Brexit through, Italy works its way through budget and a China trade deal, and the Fed doesn't go too crazy in its statements, but is more moderate based on the information, I could definitely see some spread tightening. That's not, again, I wouldn't call it, again, you have to put everything in context, right? So if you get a 50 basis point tightening, spread compression, that's 2-3 points, and plus your coupon, so you can get to high single digits. Maybe you get to 10. If you buy, obviously, a little lower quality credit, then you could do a little bit better than that. But I don't see, we're not at a moment, you can't make 20%. A lot of people say, well, hey, what about the opportunity to make 20%? Back in 2009, you made a ton. In 2010, you can't make 20% when you start with something that's yielding 7% and has a 4-year duration. But that doesn't mean you can't be a solid piece in a portfolio. And investors most investors don't have the luxury of saying, I'm going to go to all cash. As tempting as 3% might be on cash, most investors don't have that opportunity when they have 7-8% type of liability. So you have to put together a basket. We, for what it's worth, in the last number of months, throughout 2018, we reduced our high yield exposure and swapped into loan exposure. And loans have been, even through Friday, they were up 3.5% or so for the year. High yield was slightly negative. And so that move made sense. That's not to say we didn't have high yield exposure, but on a relative value basis in our multi-strategy funds, we did that. So,
is that still the case? Do you prefer, on a relative basis,
so,
you prefer loans over bonds?
So I would say that in the last couple of days, we have seen some names that have gapped down in price. And we're starting to take some of the lower risk high yield names. We had some very short duration high yield bonds that were maturing 2021, 22, and they were essentially 5%, 6%. So they've not gone down at all, and we're replacing that with some names that have gone down more. So similar to bank debt.
A lot of people, for good reason, are looking at investment grade rated debt that's trading like a fallen angel. They're looking at Ford, they're looking at GM, they're looking at GE. For a while they were looking at PG&E. We'll see what happens there. What do you think of those names, and what do you think of the potential that they represent?
So I won't comment on those names, but what I will say is I think this triple B issue is a real issue. The fact that...
It's just too much of it?
Well, a handful of things. The fact that nearly 50% of the investment grade market is triple B. That's a $3 trillion over $6 trillion market. Just to frame that for a second, $3 trillion at triple B compares to $1.5 trillion or a little bit less in the high yield market. So just the order of magnitude. Secondly, the triple B minus piece is about $550 billion. And that's where the downgrade risk is meaningful. And when there's downgrades, the market research shows that you lose 300 basis points of spread. And since investment grade is typically longer duration, you're talking about the possibility of losing 15, 20 plus points. And then I go back and say, well, what experience have I seen where this happened once before? And the answer is 2002, 2003. When you had, and to some extent 2015, 16, which we'll come back to in a second, when you had Enron and WorldCom,
and the telecom bubble
and
burst.
the whole telecom bubble burst, there was an enormous amount of investment-grade mutual funds that were forced to sell. And spreads widened out materially, and there was some great value. And the same goes, by the way, for 2015, first quarter 2016, when some of the largest commodity players who were highly levered were at risk of downgrade, and there was some very exciting opportunities. And so I think that when you look at the 500, whether it's 550 billion of the triple B minuses today, whether it's the 3 trillion of triple B in general, I think there's more exposure there. And there's lots of research out there that talks about that maybe 50% of the triple B market would actually be, has junk-like, to use your phrase, has junk-like statistics in terms of leverage levels. And so there's still a lot of triple B in energy. There's still a lot of triple B in some of the capital goods manufacturers. There's a lot of triple B in healthcare from some of the recent M&A activity. And so I do think that that is something that is bubbling along. And again, to me, it goes back to what happens when there's a downgrade. Now, the flip side, there's lots of research that people will say, well, you know, the upgrade-downgrade ratio is actually great. Although if you look at it over a 3-year average, not quite as great. And that a lot of these triple B companies really have done it for M&A, and they're going to go back. And there's certainly some good triple Bs. I'm not suggesting, just like I can't sit here and say in a broad brush that high yield or bank loans will come to distress in a minute is good or not good. Same goes for triple Bs. There's definitely good credit pickers, opportunities to make incremental spread.
So what precipitates a raft of triple B downgrades?
Well, a few things. Again, to the extent, same
Like
thing.
it has to.
So
there has to be a
let's-
bunch of them for it to become a problem, right?
Well, again, when it's a when it's a $3 trillion market on a dollar basis, think about the technicals. Again, one of the things that as the older I get, the more I appreciate the importance of technicals for someone who grew up my entire life as a fundamental investor. The reality is when something is for sale and there is a forced seller, price goes down. And again, the fact that leverage loans and high yield got to 70 cents on the dollar in 2000, fourth quarter, first half of 2009, wasn't because the value belonged there. It was because there was just forced selling. And so the question comes back to what are the conditions? And it goes back to the same thing I said. If there is a recession, there's meaningful deterioration in credit statistics. If there is in certain industries like energy, you know, again, one of my colleagues said today, you know, is this November 2014 when people felt like, okay, we went down from 75 to 50, we're fine now, or could it go lower?
Right. Or
And
staring 26
so,
in the
you know,
face again.
and there's healthcare and there's consumer
Okay.
products. So again, I don't see it necessarily happening tomorrow, but you ask yourself, what are the conditions that happen? And if there's a recession, when there's a recession, there will clearly be some more deterioration in the energy sector, I think, has exposure.
Why is there so little distress?
Well, it's really the flip side of exactly what we've been talking about for the last 15, 20 minutes. In a market where the economy is growing, the capital markets are open, there's a lot of available capital, then you really wouldn't expect to see a lot of distress. But where there is distress today is in industries that are getting disrupted, okay? And retail, as example, is one of those great areas where the change in store-based retail to online retail has been extraordinarily painful for so many retailers. And again, whether it's Sears or whether it's Toys R Us, and there's lots of other issues with those companies too. But Amazon and other online retailers have changed things. And what you see is it's not just the store-based retail concepts. It's also certain product lines. You take something in like the mattress companies, the fact that online penetration of mattress sales today is, I think, in the neighborhood of 25% from zero, that changes the whole profit margin opportunity for the department stores and specialty stores that were selling that product. And so there are industries getting dislocated. And I think disruption is as big an issue as recession in terms of what happens for a lot of leveraged credits. Because again, when there's disruption, what do brands mean today? I mean, we can look at the investment grade or the high quality equities that we all grew up with, and do those brands mean as much today to the next generation, to the millennials? And the answer is they don't. So what does that mean going forward? And so I think when we look at every single company that we invest in, we ask ourselves, where's the risk of disruption?
So on a sector by sector or industry by industry basis, where in addition to retail, do you see the most risk of disruption?
Right. So again, what the market today, the only places where there is that in the market, the distress ratio today is 6%. Okay, it was 20+% in the first quarter of 16. So when you make the comment going full circle, oh, it's the worst year since 2008, I can assure you those 4 months between November and February felt a lot worse than they do today. The market today is again, it's retail, it's energy, it's fixed line telecom, and then there's some segments in chemicals. So in the U.S., that's the U.S. for a second. So the U.S. liquid distressed market today, the opportunity set is in more challenged companies, and there's certainly some opportunities from time to time in those over-levered companies, but it's more challenging because there's industry set of issues or there's management issues or it's just too much darn leverage. We actually been spending much more of our time on the distress side in Europe, not in the liquid credit markets either, because there's not so much distress in the market today, although you're starting to see more cracks in that market because of European weakness. But again, that's 4%.
Fundamental economic.
Well, the economic recovery in Europe has been a lot slower, not just Brexit. If you look at the German and French PMIs, they're down. It's funny, to go back full circle for a second. We started the year, it was global synchronized growth, the tailwind of tax cuts, and now global synchronized growth doesn't feel there, and the tax cuts we spent. So that's why, again, there's more anxiety. But in Europe, again, some of the capital goods companies are getting hurt. Some of the chemical companies are getting hurt. Where we're actually spending a lot of our time is on shipping, which has been a sector that a lot of people have, more people have lost money and been challenged by the sector. But we think there's an interesting opportunity today in some of the debt that the German banks in particular have been selling because it's closer to the maturity, and we think there's an opportunity to take the collateral, either that or work it out with the existing owner. There's real estate opportunities in Spain. Spain has actually been doing reasonably well. Italy is still challenged, and there's some selective opportunities that we're looking at, but that script is still being written.
What about across the channel? What if Theresa May can't get a Brexit deal done?
Well,
with her own parliament.
Sure.
She's now worked it out with the Europeans.
Well, for now, right? Look, I think that would be seemingly to me an event that would cause some dislocation. Although it's been pretty remarkable, if you look at all the dislocating events over the last decade, people ended up buying and the market rallied back.
Which is why I ask. I mean, is that...
Yeah, look, I think the market by and large still expects there to be a deal. And if there truly was a hard Brexit that was devastating, I think the markets would react negatively.
Does that create opportunities for you?
Sure. No, look, the thing, I joke around both internally and externally. I don't exactly know what I'm rooting for every day. We ultimately want to make money for our investors, and so when the markets are performing well, we're excited about the beta and the alpha opportunity, which we think exists in good markets too. When the market is underperforming, we have the opportunity to use the distress capability that we built up over 30 years to seize on the market. We have a very large distressed fund that we raised 2 years ago that has billions of dollars of dry powder that we've been waiting on. A number of investors actually recently with us and with others have been setting up separate accounts that only take effect. The investment period starts when high yield spreads widen. So I think that if the market, whether it's Brexit, whether it's a very troubling meeting between President Trump and President Xi, whether there's Italy issues, I think that if there's market opportunity, then we and our brethren have a lot of capital seizing that opportunity. There will be some who will be forced to sell or will choose to sell because of fear, and that's when often there's some very good opportunity.
What you're rooting for is overreaction.
Yeah, I think that overreaction is good, as long as you don't get swept in it yourself. But yes.
I want to cover a couple of things quickly. There are a lot of questions. There remain a lot of questions about the boom in private credit and direct lending.
Mm-hmm.
You guys have participated.
Yep.
Where do you see signs of excess, or are those concerns overblown?
So, private credit is one of those category names that gets a lot of usage and used differently. So there is lots of forms of private credit. There is middle market credit. There is hard asset credit. There is customized credit for larger deals. There's there's a whole host of private credit. What I will tell you is that it seemed to us on the lower end of the middle market that given the amount of BDC capital that existed a couple years ago when some of the BDCs, many of the BDCs were trading above NAV and were issuing lots of equity, that the lending practices got very aggressive. With so many of the BDCs trading at a discount today, that's less of a factor. There are certainly some very good middle market debt investors, and I think they have that have the ability to do the diligence, structure the deal the way they like, and while spreads probably feel like they may have gotten a little tight in there, and I want to come back, by the way, to bank loans and CLO pricing, but while pricing may have gotten tight, I think that the credit was okay. And again, just like anything I've been speaking about this whole discussion, I do think that good credit investing, like good private equity investing, like good equity investing, people can make a difference and create alpha. What I would say, where we see a lot of opportunity and we're quite excited about in private credit, is actually some of the larger deals that are getting done, where the sponsor or the company is choosing not to go a syndicated route because they think that there's a story in the company that could take a couple of years to play out because they're under time pressure to get a transaction done because they don't want to take short-term market risk. And so to me, there's opportunity because the banks in the syndicated market might not give leverage in certain industries, like software, for example, where some of the best deals done in the last decade were in the software space, but the prices paid on an EBITDA multiple are quite high, and yet you can create some double-digit returns at the 50-60% loan to value, which is very exciting to us. And so one of the stories I tell is I feel like we're in kind of maybe it's because this is my fourth decade doing it, I feel like we're kind of in the fourth decade of the evolution of leverage finance, and I'll describe it quickly. The first decade was really driven by, we talked about Mike Milken earlier, Drexel, and really by the high-yield trading firms. That was really, whether it's Drexel, whether it was Merrill, whether it was what was First Boston, and DLJ after Drexel. That was the first decade. The second decade was the banks took it over. The banks either bought or built out their businesses, and the second decade in leverage finance was all about the banks. Then you have the global financial crisis, and the banks pulled back, and large alternative asset managers like ourselves, like so many of our competitors, got built very large-scale businesses, and the private equity business became more professionalized, hiring bank people to do capital markets. And so now we're in this fourth decade where it's kind of an interesting evolution in that the syndicated deals go to the banks because they don't really generally want to take risk, and the more complex transactions get negotiated directly. And for my part, if we have the opportunity to leverage relationship with either sponsors or with particular companies that we've been following for decades, if we have the opportunity to do more diligence by being private and working with the company and the management team in a lot more active way than we do in a syndicated transaction, if we have the ability to leverage all of our relationships and then structure a piece of paper that fits us and fits the issuer, that's good for both sides. And so I think there's going to continue to be this evolution where large institutional players like ourselves seize on that opportunity.
I'm testing your patience and those of my producers, but I have to cover a couple of other
Who's
things
bored yet?
quickly.
When exactly did boring start?
I'm testing
Was
your
boring like
patience.
T-minus, like was it 5 minutes in, 10 minutes in?
No, your generosity. I'm testing your generosity.
I don't get you in my office often, man.
No, it's
So
true.
come on, I'm on a roll now. I can go for an hour. Someone please stay. Come on.
I want to go back for a moment to what you were saying about opportunities that may arise either in a distress cycle or a forced selling situation in a triple B downgrade,
Okay.
a widely spread triple B downgrade. How much money can you marshal If you think back to what you invested in the sort of late fourth quarter of 2015, into mid-February of 2016, and the opportunities that you probably missed along the way because you couldn't marshal enough capital, what are you ready for now? How much dry powder do you have? How much can you commit?
So we have I'd say in excess of $5 billion of available capital to seize on the opportunity, with existing pools of capital that are raised and allocating some of our capital away from low risk opportunities to where there could be potentially much larger opportunities.
It's a lot of money.
I would say that we have a number of investors who are increasingly more tactical. So one of the things that's interesting, by the way, I commented in the evolution of the leveraged finance market, the growing alternative asset managers like ourselves and the sophistication of private equity, the investor base has gotten increasingly sophisticated too. And so I believe that were spreads to widen to 600, 700, 800, there would be a substantial amount of capital that would come in on the assumption that it was not for any other totally dislocating events in the world. If equities were down 30%, then I think that amount of capital would be lower. But I think if there is something that's particular, if whether it's Paul Tudor Jones or anyone else is right, and they certainly can be, then I believe that there would be substantial capital. One of our biggest fundraising years was in 2009, right after the crisis, because investors saw the opportunity. So I don't believe we're in a position again to be down 30 points in credit. There's just not that kind of forced selling out there. But that doesn't mean that you can't be down in some industries 20, 30, 40 points. And again, my point earlier, when you have low coupon debt, in the old days when I started, high yield coupons were 13, 14, 15, 16, 17%. And so you made a lot of money just on the coupon. Today, when you're making 4, 5, 6 on the coupon, the price movement and that repricing of yield is really going to make a big difference. And so I think what is more likely is if you have a recession, when you have a recession, spreads will widen. I don't think there will be a lot of defaults, but I think there's going to be a lot of great opportunity in buying bonds at 50, 60, 70 that have just been repriced from 6% to 12% or whatever the yield might be, or 15%, and then either working with the company towards restructuring in 2022, 23, 24, or there'll be a rally back and the economy will be in decent shape and they'll be able to refinance themselves. And so, again, I think there's going to be lots of opportunity. We have a lot of we have a lot of capital committed today. We have a lot of capital on the sidelines that I expect we'll be able to draw upon.
$5 billion or more?
$5 billion or more.
$5 billion or more. And how quickly can you mobilize it?
We have it on hand. We have it
now.
We have delayed draw capital call. I mean, it's some of the money is in funds that are 10-day capital calls, but I mean we have subscription line financing to enable pretty much overnight financing. So we have a lot of capital available, and we're not alone. And again, when you have that capital available, and we're just one party, and we're under no illusions that we don't think we're the only party, that is going to temper a massive sell-off because everyone is looking for the opportunity. Sure. And now again, I think we can find it. I think we will find it. And if it's a major dislocation, then we'll have that opportunity even in a larger way.
The future of Oak Hill, this is roughly speaking a $35 billion firm?
Roughly speaking, somewhere between 33 and 35.
How much bigger could it get?
So what I've said to investors, what I've said to our team is our goal is, as hokey as it might sound, our goal is to ultimately provide great returns for our investors on an absolute risk-adjusted return basis, and it's to provide our team with a great opportunity for their careers.
The reason I ask the question is because some people make a persuasive case that scale increasingly matters. The ability to write large checks,
Sure.
and private lending arrangements,
Sure.
the ability to mobilize a lot of capital in a market dislocation isn't just important in terms of being able to take advantage of the opportunities. Sometimes it can actually create greater returns.
Let's be clear, okay? So number one, I think at 33, 35 billion, we have substantial and meaningful scale. And what I say is we're large enough to have scale and to be relevant and to write those larger checks. And we're small enough to still be nimble. What I was saying a moment ago is our track record, our culture are the two most important things to us. Because if we have a great track record and continue to perform, it's been 31 years, if we continue to perform well, and if we have a team that's happy and that is motivated and engaged and sees growth opportunity, then that will be self-fulfilling, hopefully, and our process continues to work. So I believe we have the opportunity to grow. I think that size, that the investor is looking for fewer relationships. I think many of the institutional investors became over-diversified in credit and equities and private equity and many strategies. And so we have built a very large business around large separate accounts for some of the world's largest institutional investors. And we think there's opportunity to get substantially more growth from those investors if we do a good job. And so I don't have a number. I don't have a goal. My goal is to continue to try and service our clients and do a good job and have the team here feel rewarded and have growth opportunities. So
one of the reasons you've been able to attract capital isn't just by generating returns, it's because there has been this shift out of public markets and into alternatives.
Mm-hmm.
But the shift isn't just going into credit, it's going into private equity, it's going into real estate, it's going into other alternative assets. Is there a future for Oak Hill beyond credit?
Sure.
Do you want to have private equity? Do you want to have real estate? Do you feel you need it?
So what I would say is I don't think we need it. I think that we have found many, many of the world's largest investors who look at credit as an asset class where they like to have a specialist and have a view that some of the multi-alternative asset managers are perhaps too distracted by their varied range of activities. Although for sure, some of the world's largest and most successful alternative investment firms have done a great job. But what we have found with our investors, and we've been fortunate to, again, raise capital from some of the world's largest, most prominent, sophisticated investors, is I think they like our credit specialization. Now, does that mean that if we had a real estate credit product, that might make us better? I think the answer is yes, it might make us better. And if we could provide that product to our investors, then I think that's something that, for example, could be something that we add on to our business over time. And we certainly think about other products, other regions. But the whole key is doing something well and having competitive advantage. And I would rather not be in any other strategy if we don't think we can build a genuine competitive advantage. And so it's just, again, it goes back to the simple point of the track record, and the culture is just too important. I do envision us growing over the next decade and 2 decades and decades beyond that, hopefully. And I certainly could envision us having other products to go along to complement what we have and to build deeper relationships with the investors. And we're certainly looking at opportunities from time to time, and you'll be the first one I call when we do something.